What we're going to look at here is a type of investing with shares called options. And in particular, let's look at a strategy called covered calls. Now, this is for people who currently own shares in the market, so this could be you. It's also designed to be a very conservative strategy, which could match your investing style. Now, it's designed to make additional income from your shares, and that is over and above the dividends you get paid and also the potential share price increases that you might get if the shares are going up. Now, let's start with an example using company ABC on the stock market that you hold, and let's say they're trading at a nice even $5. What you're going to do is offer a potential buyer the chance or the option of purchasing those shares at a designated price in the future. Now, you get to decide what that price is, and let's say you've decided $5.50 is what you would be happy to sell them for. Now, that could coincide with a 10% increase, and maybe that's part of your strategy, knowing they're at $5, and should they get to $5.50, that's the 10% I was looking for out of that share. I'm happy to sell. Now, on the other side of the coin, we need a buyer. Now, the buyer of these calls is a real bargain hunter in the market, and they're looking for a good deal. So what they're going to say is, yes, I will buy those off you for $5.50 if they get to $5.50, but only for $5.50. What they want is for them to go up as high as possible beyond that. Now, what the buyer will do is look at company ABC and be happy with the $5.50, and in their mind, they think they've still got a little bit left to go up after that. Now, let's have a look at how the process works. The buyer will pay a premium to you, and that is the price the buyer pays for the right to purchase the shares at $5.50, but only at $5.50. That's their only obligation, remembering they are wanting them to go up as high as possible after the $5.50. So let's move forward. The calls in Australia expire on the last Thursday of every month. Now, that is Australia. If you're looking overseas, you want to check other international markets on when their calls expire. So moving forward, what we've got to is example, the last Thursday, and let's say for this instance, it's going to be the 28th day of the month. Now, there's two possible outcomes that could happen at any point leading up to or on the 28th of the month. And that is, it's either going to be above the $5.50 or it's going to be below the $5.50, up to and including that 28th day of the month at any point within that range. Now, let's have a look at what happens if it's above the $5.50, if it gets to that price that you are asking from a buyer. You've hit what's called the strike price, and at that point you are obliged to sell because you entered into a contract saying that's what you wanted and that's what you would be willing to sell for. Keeping in mind, you've got your 10%. It may go higher, you may miss out on a little more, but you said you'd sell them for $5.50. You've got to be happy with that. Now, let's have a look. There's your 10% you've made, and also you get to keep the premium. So you're out of the shares, but you've got the option of now buying back in if they are still on a good roll going up. Now, the buyer has the right, but not the obligation to take them off you before the 28th. They only have to buy them off you for the $5.50 designated price that they've paid their premium for. This trader wants to see them go up even more, higher. If he can get $6.07, so be it. Their only obligation is that agreement of the $5.50. So what they ultimately want is to buy a $7 share off you, for example, for $5.50. And there, they wanting them to go as high as possible. Now, the other option is what happens if it's below $5.50 at any given point, but in particular up until that last day of the month. Well, you get to keep your shares, so that's not a bad thing. Plus, you get to keep the premium that the potential buyer put up for the right to purchase them from you should it have reached $5.50. Now, covered calls can potentially be seen as a high-risk investment. Any form of investment where you put your money down without having a guaranteed return is high risk, and you have to take into account those high-risk elements of any particular type of investing. What you need to do is have a risk management strategy in place. And for things like covered calls and share trading, you have things what are called stops, which means it goes down to a certain point, and at that point you may have lost a little, but you're out. You haven't blown all your capital. When you're a trader and part of your risk management strategy the number one most important thing is the preservation of your capital. It is number one. Keep in mind, you've worked a long time to earn that money. It could be your savings, it could be your super. It has to be treated with respect. So what you need as part of the risk management strategy is help with brokers or advisors or fund managers, people who've been through it before and know all these different products. So have a look at our risk management video. Get a better understanding of covered calls, how they work, what are the risks, and could they work for you? And if they can, happy trading, enjoy the covered calls. As for now, thanks for watching.